Imagine it's November 2001, Buenos Aires, you're a school teacher. You've worked 27 years. Every month, a portion of your salary went directly into your savings account, a peso account, then later a dollar account, because the government told you the peso was now fixed to the dollar. 1-to-1, locked, guaranteed. You did everything right. You didn't gamble on stocks. You didn't take risks. You trusted the bank. You trusted the government. You trusted the peg. Then, on December 1st, the government announced El Corralito, the little fence. Bank withdrawals frozen. Your 40,000 in savings is technically still there, on paper, in a ledger somewhere, but you cannot touch it, not 1 peso. 3 months later, the peg breaks. The government converts your dollar savings to pesos at a forced rate of 4-to-1. By the end of 2002, the real exchange rate is 4-to-1. You have lost 60% of your life savings, not because of a robbery, not because of a bad investment decision, because of a policy mechanism, a structural sequence that runs the same way every single time a system approaches collapse. You didn't lose your savings in a market crash. You lost them in an orderly, bureaucratic process. That is the part most people never discuss. This isn't a story about Argentina. It isn't a story about bad luck or political incompetence unique to one country. It happened in Weimar Germany in 1923. It happened in Zimbabwe between 2007 and 2009. It happened in a slower form through the 2008 financial crisis in the United States, 11 trillion in household wealth erased in less than 18 months. The people who lost the most were not reckless speculators. They were savers. They were rule followers. They were people who trusted the instruments the system told them to trust. This isn't theory. It's documented history. And once you see the pattern, you can't unsee it. The pattern is this in every financial collapse. Certain instruments die first, not last, not equally first, and the sequence is not random, it is structural. It follows the same chain of failure, because these instruments share the same fatal characteristic. They are all claims on value, not value itself. Here is what dies first, in order. Before we name them, you need to understand the core mechanism. Modern financial systems are built on a layered architecture of promises. Cash is a promise from a central bank. A bond is a promise from a government. A savings account is a promise from a commercial bank. A pension is a promise from a fund manager or an employer. A mortgage-backed security is a promise built on top of other promises. When a system is functioning, these layers of promises hold. Confidence is the glue. When confidence begins to crack, whether from currency debasement, sovereign default, bank insolvency, or a collapsing real estate market, the crack does not move randomly through the system. It follows the liquidity ladder from the most abstract and leveraged instruments downward. The Cantillon effect explains part of this. Those closest to the money creation process absorb the new value first. Everyone else absorbs the dilution. But there is a second mechanism, the hierarchy of claim. The further you are from a hard, tangible asset, the faster you reach zero. With that mechanism in mind, here are the 7 things that become worthless first. 1. Cash savings held in domestic bank accounts. This is not the cash in your hand. This is the number on a screen inside a bank that is itself leveraged 10-to-1 against its deposits. In Weimar Germany, middle-class families who had saved their entire lives in mark-denominated accounts watched those balances become, within months, insufficient to buy a single loaf of bread. In Argentina, the accounts were frozen before the devaluation, so the government could control the conversion rate. The saver had no exit. The sequence was freeze, convert, devalue. Always in that order. Cash savings in a failing currency are not savings. They are unsecured loans to a bank, denominated in an instrument the government controls. 2. Government bonds and sovereign debt. Government bonds are considered the risk-free benchmark of most financial systems. This is the narrative. The mechanism is different. A government bond is a promise by the same entity that controls the currency to repay you in that same currency. If the currency collapses, the repayment is nominal. You receive your money back. It is simply worth nothing. Argentina defaulted on $132 billion in sovereign debt in 2001 at the time, the largest sovereign default in history. Bondholders received cents on the dollar after years of legal wrangling. The instrument that every pension fund and insurance company in the country held as its safe core holding was the first institutional domino to fall. 3. Pension fund balances. A pension is a promise deferred across decades. It is one of the most temporally fragile instruments that exists. Pension funds are structurally required to hold large percentages of government bonds and investment-grade debt, the exact instruments that collapse in a sovereign debt crisis. They are also subject to regulatory control. In a crisis, governments have historically raided, frozen, or forcibly converted pension assets to manage sovereign debt obligations. Argentina did it in 2008. Hungary did it in 2010. Poland restructured its private pension system in 2013. The pension is vulnerable not just to market forces, but to legislative ones. It can be rewritten overnight. 4. Insurance policies and annuities denominated in fiat. A life insurance policy or annuity promises to pay you a fixed nominal sum at a future date. In a stable monetary environment, this is valuable. In a hyperinflationary one, the nominal sum is preserved. The purchasing power is not. In Weimar Germany, families who had dutifully paid life insurance premiums for decades received their full policy payout in 1923 and could not buy a week's worth of groceries with it. The insurer met its contractual obligation perfectly. The contract was worthless because the unit of measurement had been destroyed. Not fraud, not theft, arithmetic, mortgage, securities, and structured financial products. These instruments are built on multiple layers of claims. A mortgage-backed security is a claim on cash flows from mortgages, which are themselves claims on property values, which are themselves contingent on employment, income, and functioning credit markets. In 2008, the U.S. housing market's decline triggered a cascade through this entire chain. Banks that had classified these instruments as safe assets saw their balance sheets collapse. The IMF estimated losses of over $1 trillion on toxic assets between January 2007 and September 2009. The instruments that financial engineers had rated as near zero risk vanished first, because they were the furthest removed from underlying reality. The more complex the instrument, the more links in the chain can break. 6. Stocks in banks and overleveraged financial institutions. Bank stocks are not equity in productive machinery. They are equity in leveraged trust institutions that borrow short, lend long, and depend entirely on confidence to remain solvent. In every financial collapse, financial sector equities lead the decline. In 2008, Lehman Brothers stock went from 86 to 0 in 12 months. In Iceland, the entire banking system holding assets 10 times the country's GDP failed within a week. Wachovia, Bear Stearns, Washington Mutual equities that took years to build and days to erase. Owning a bank stock in a failing system is owning a claim on a leveraged claim on trust. When trust goes, there is no floor. 7. Certificates and paper claims on hard assets. This is the most misunderstood category. Many people believe that owning a paper claim on a hard asset, a certificate of deposit tied to gold, a warehouse receipt for commodities, a title to property in a jurisdiction experiencing institutional collapse, gives them exposure to the hard asset's value. It does not. It gives them exposure to the integrity of the institution holding or registering that claim. In Zimbabwe, land titles became unenforceable as property rights collapsed under forced redistribution policies. The title was real. The legal framework backing it dissolved. In Cyprus in 2013, depositors with certificates of deposit above 100,000 had a portion confiscated a direct bail in. The asset existed. The claim to its full value did not survive. Paper is only as strong as the institution that backs it. All 7 of these instruments share one structural characteristic. They are held predominantly by the middle class, by savers, by rule followers, by people who did what the system advised. The wealth transfer in a financial collapse is not mysterious. It follows a clean, documented path. Debtors, with hard asset collateral benefit inflation, erodes the real value of their liabilities, while their assets hold value. The Roman Empire systematically debased its silver coinage from nearly pure silver to under 5% silver content. Over 2 centuries, real debt obligations fell while asset holders retained value. Governments benefit because inflation inflates away the real cost of sovereign debt. Those who received new money, first the Cantillon insiders, converted it into real assets before the devaluation reached the general economy. Who pays? The schoolteacher in Buenos Aires, the factory worker in Weimar Berlin who saved in marks for 30 years, the retiree in 2008 whose pension fund was 60 investment-grade bonds. The trap for policymakers: is this the only way to stop the inflation mechanism? Is to raise interest rates aggressively, which collapses asset prices and triggers the recession those same policies were designed to prevent. The medicine and the poison are the same substance, administered in different doses. There is no clean exit. There is only a choice of who absorbs the pain, and historically, that choice is never the creditor class. This is historical and educational analysis. It is not financial or investment advice. 7 instruments, all paper, all promises, all sitting at the top of the claim hierarchy, furthest from tangible reality, held by the people with the least political power to protect them. The mechanism does not require malice. It does not require conspiracy. It requires only a system under stress, following its own internal logic to its terminal conclusion. This channel exists to study the autopsies before they repeat. Most people won't see these patterns until it's too late. If this lens was useful to you, consider subscribing. The pattern is already in motion.